This is not a video about a specific stock, but about an occasion that happens from time to time and that offers incredible stock prices. The trickle-down effect. Hi, my name is Till and this is the channel where you learn how to invest intelligently and how you build a fortune as a private person. When you're new here, click the subscribe button and don't forget to ring the little bell so that you're immediately informed about new videos. There are a lot of investment strategies and procedures and things that can be used for smart and intelligent investing. But how is it possible that some investors make huge profits without really doing much in the stock markets? Without constantly buying and selling and watching what the markets do. One of the major reasons is that they know about a phenomenon called the trickle-down effect, and they are aware of which ridiculously cheap stock prices this effect offers. It is really fascinating. We show you in this video what this effect actually is and how it works. We talk about how big this effect is and how often it appears. And we talk about what exactly you need to do so you can make use of it for yourself. Make sure that you stick around till the end, because as a bonus we tell you the 3 major mistakes a lot of investors who are chasing this effect make and how you avoid them. So let's jump into it. What is the trickle-down effect and how does it work? When you've already watched the video on Mr. Market and his mood swings, you know by now that markets are most of the time quite efficient and the stock prices often tend to reflect the inner value of the business behind the stocks. But sometimes the markets become irrational and you'll be offered prices that are either much lower or also higher than the true value of the businesses. Benjamin Graham's analogy of Mr. Market describes this irrational behavior pretty well. He firstly laid it out in his famous book, The Intelligent Investor. The reasons for this are really manifold. Quite often, the root causes are actual or assumed crisis situations. I say assumed because the markets sometimes believe that a company is in a crisis, although it is doing pretty well. The markets just don't see it. A crisis can happen at least on 3 different levels. The company itself might come in a crisis. Maybe because they made a mistake with the production of a new and important product. The industry the company is in might come in a crisis. Maybe because the markets are satisfied with certain products and consumers just buy less of them. Number 3, the general economy might be in a crisis, locally or also globally. This also could be caused by several factors, like, for example, inflation or military conflicts or natural hazards. Every one of these effects individually can already influence the prices of a stock significantly, while the underlying business is still completely intact. But from time to time it happens that these effects occur at the same time. They sort of overlay and amplify each other. Sometimes this can even cause the avalanche effect. This is, by the way, another strong crisis effect with a huge impact on stock pricing that I will explain in a different video soon, and that is going to be linked here somewhere in the corner as soon as it is available. It also happens that the effects on the different levels trigger each other, so that a crisis situation on one level causes a crisis situation on another level. How big is the effect? Quantifying something in the world of the stock markets is really not that easy. Not even to say that it is working in this or that range. And this is because it is a social phenomenon and not an event of natural science. It is really hard to measure it because there are a lot of variables that influence this effect. I personally saw stock prices going even below 1/3 of my calculated inner value of a business. And I remember that I was quite conservative with the calculation of the inner value. But this is just an indication. The effect is one that is happening in extreme situations, and those can come in more or also less strong. The next time is always a bit different. Even huge, strong companies like, for example, Coca-Cola are affected by it sometimes. You can check this for yourself. Go to any finance information website, like, for example, Morningstar.com or Yahoo Finance, and look at the stock price charts of great companies for the year 2020 until today, which is March 2021. The Corona crisis isn't really over yet, but even Coca-Cola stock price fluctuated between $38 and $60 during that time. And for Coca-Cola, this was, by my estimation, just a double down effect. They were hit by the global economy and maybe a sort of a crisis in the consumer goods markets. The company itself wasn't seen to be in a crisis by itself, as far as I remember. Is this really happening, and if so, what's the likelihood? Oh yes, it is. And frankly, it is one piece of my personal investment strategy to sit on my butt and wait for this effect to happen one day. Or, as Charlie Munger, the congenial partner of Warren Buffett, once put it, assiduity is the ability to sit on your ass and do nothing until a great opportunity presents itself. Munger most probably never said this that way. He said something slightly different on assiduity, but this is one of the misquotes that are just too good to not be repeated. In the past 20 years, there have been at least 4 major global crisis situations. The last 2 of them happening in 2008-2009 and then in 2020, caused by the coronavirus spread. All of those offered several of these effects in different industries. So, since the last crisis, you had to wait for more than 10 years for a similar situation. As promised, here's the bonus I was talking about in the beginning of the video. The 3 major mistakes investors make with the trickle-down effect and how you avoid them. Mistake number 1. Losing patience. This is probably the biggest mistake and the hardest part to overcome. To lose patience while you're waiting for the effect to happen. Losing patience means that you stop believing that there is actually a next time and start doing stupid things like, for example, buying stocks for prices that are too expensive. Just because everybody is doing it and the stock prices developed so nicely recently. The thing is, there is always a next time. Warren Buffett once said, "It is much easier to predict what will happen than when it will actually happen." Staying put and not doing anything stupid is the big emotional task you will have to handle. Mistake number 2. Not doing your homework. Let's say you saved some money that you would like to invest and you wait for the trickle-down effect to happen. And suddenly the time comes and you see that the markets crash and everybody is talking about a global crisis of economy. What now? If you haven't made use of the time since the last crash and analyzed stocks, if you haven't built up your personal watch list and have your 1 or 2 handful of truly great companies available, you won't know what to invest in and at which prices you should actually buy. Doing your homework means that you prepare yourself. You search for and you find great companies that you would like to own and where you understand the business. And you learn to invest. A major part of this is learning how to calculate or to approach the inner value of a company and to derive from that your understanding of a truly cheap purchase price. this channel is going to support you with exactly this. Mistake number 3. Not to learn how to control your emotions on the battlefield. It is a typical hallmark of a crisis that emotions, especially like fear, will take over control of the markets and the minds of a lot of people. This is normal and it is of course understandable because, let's be honest, a huge crisis is a dramatic event for a lot of people where they lose money and risk to lose their jobs. These emotions will most likely also affect yourself. You have to be aware of that. When your job is at risk, you will probably invest much less lightly. But there are strategies to handle these situations. Number 1, prepare your financials in advance. Save enough money so that you have a buffer to overcome your financial needs during the crisis, while you still have enough money to make use of the situation and invest. Number 2, learn more about what emotions are and how they affect your thinking and your behavior. This is really the first step to control them in your investment activities. Always remember that every single buy and every single sell of a stock that you make is going to be influenced also by your emotions. The better you understand how they work, the easier it will be to reduce their influence and to increase the influence of your rationality and your figures and analyses. Number 3. Work out your analyses and prepare your tools before the crisis appears. They will not be influenced as much by emotions then. When the crisis arrives, you can pull them out of your shelf and act on them. I hope you can follow a bit better why I believe that I didn't exaggerate when I talked in the beginning of this video about the huge opportunities and the ridiculously cheap stock prices that this effect sometimes offers. When you liked the video and when you want to know more about how to build up a fortune as a private person, click the subscribe button, browse through the other videos on my channel, and it would be great if you leave a thumbs up. And if you didn't like it, leave a thumbs up anyway. The links to this video you will find as usual in the box below this video. Drop your comments and opinions in the comment section. I wish you a lot of success with your investment activities and see you in the next video.